Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. We have a critical deep dive today, and we're looking at three global themes that on the surface seem completely separate.
That's right. We're talking about the future of energy, the incredible thirst of artificial intelligence, and the geopolitical cracks that are really starting to show in Europe.
And our mission here is to connect those threads, because recent analyses suggest they're all pointing to one central reality, the immense and often hidden cost of structural transition.
That's a perfect way to look at it. We're tracking capital and strategic decisions across, well, a few different worlds.
Right.
First, the physical world, where you've got these massive mining deals driven by resource constraints. Then the digital world, where Meta's power strategy signals a completely new AI bottleneck.
And finally, the strategic world.
Exactly, where Europe is grappling with the dissolution of the very international order it was built on. We've pulled the key data to show you exactly why navigating these transitions is, I think, the most important challenge for global capital today.
Okay, let's unpack this. Let's jump right into our first topic, the copper prize. The headlines have really been dominated by these preliminary talks between two absolute titans of mining, Rio Tinto and Glencore.
Two giants.
And if this deal actually happens, we're talking about a global mining powerhouse, potentially valued around $207 billion.
That valuation really shows you the stakes here. And the critical question, like you said, is why now? Why is this happening right now?
Yeah.
The investigation suggests it's not just your basic commodity cycle. It's really about the urgent strategic value of copper.
And that value is escalating because of what some analysts are calling a dual demand shock.
A dual shock, exactly. Shock number one is the one we all know about, the energy transition.
So new power grids, wind farms, solar.
Right. All of which need just exponential amounts of copper. But shock number two is the one that's really accelerating. It's the massive expansion of AI data centers, which, we'll dig into more in a bit.
Every new server rack, every power converter.
All of it. Every one of those digital factories needs vast amounts of copper.
So the data is pretty clear that demand is projected to rise significantly, maybe a third, by 2040. And that forecast is fueling this M&A frenzy.
It is. But the real insight here isn't actually the price forecast, it's the supply problem.
Oh, okay.
This is where it gets really interesting. New copper mines are incredibly difficult to bring online. I mean, we're talking about massive upfront capital investment, what we call CapEx.
Yeah, the lead times are huge.
A decade, often a decade or more from the moment you find it to the first piece of ore coming out of the ground. And you're constantly fighting regulatory roadblocks, infrastructure problems, community challenges.
So if you're Rio Tinto and you desperately need more copper for the next 2 decades, what's your alternative to, just waiting 10 years?
You buy it.
Simple as that.
Instead of spending a decade trying to build a new factory from scratch, you buy an existing one. Or, even more importantly, you buy a pipeline of assets that are already permitted or in development. An acquisition basically buys you time.
And de-risk the whole thing.
Exactly. And that scarcity is what makes a company like Glencore, with its existing copper assets, such a prime target.
That urgency makes sense. Now, the market reaction was immediate. Rio Tinto, the buyer, their stock dropped, while Glencore, the target, surged. Why does the buyer almost always take that immediate hit?
Well, that immediate discount on Rio Tinto is the market pricing in what we call deal risk over the potential synergy.
Yeah.
The market looks at 4 main risk factors. First, just the fear of overpaying. Second, the sheer difficulty of integrating 2 huge global companies. It's a logistical nightmare.
And the third?
Regulatory risk, especially from China, given its role in commodities. And then finally, the big one, Glencore's massive coal liability.
Let's talk about that, the coal clash. Because this seems to be the fundamental conflict. Rio Tinto has spent years building this green portfolio image. They're completely out of coal.
Completely out. Meanwhile, Glencore is one of the world's largest coal suppliers.
It's a huge mismatch.
The analogy I saw in the financial press was pretty striking. It's like a vegetarian proposing to the butcher.
That's perfect.
Yeah.
So Rio Tinto wants the butcher's prime cuts, the copper assets, but they have to figure out what to do with all the baggage.
The coal.
That's the baggage. And spinning off a business that large isn't a clean process. You've got massive tax liabilities, complex regulatory hurdles, and you need shareholders to agree to it. It's not just about optics. It's about real financial and legal friction.
And all of this friction has a hard deadline attached to it.
It does. Under UK takeover rules, Rio has to declare its official intention by February 5th. That date is like an option expiration date for all this uncertainty.
So for you, as a listener trying to make sense of this, what's the key takeaway?
The whole situation reflects a very long-term, very bullish view on copper, no doubt.
Yeah.
But for today, you have to mentally separate the copper is strong thesis from the deal will happen premium.
So you can be right on copper, but if the deal falls apart? Exactly. If the deal breaks down because of the coal issue, or say China objects, that acquisition premium built into Glencore's stock, it just evaporates instantly. It's a classic case of separating the fundamental value from the transactional risk.
That is a sharp distinction. Okay, so if the fight for copper shows us the resource constraint, let's pivot to the power constraint, which is now defining the AI arms race. Let's move to topic 2, AI's power thirst.
It's a huge story. Recent analyses have confirmed that Meta has made this really aggressive, almost shocking move to secure future power.
Becoming a leading private purchaser of nuclear capacity, we're talking about a roadmap to secure 6.6 gigawatts of power.
6.6 gigawatts. It's a staggering number.
Can you put that in context for us? What does that even mean?
Well, a single gigawatt can power hundreds of thousands of homes. It's roughly the capacity of a very large nuclear plant. So securing 6.6 is like building several major power stations just for their data centers.
Well,
But it's crucial to understand that is not instant power. It's a secured pipeline that stretches out to the mid-2030s.
okay, so how are they building that pipeline?
It's a two-part strategy. Component 1 is near-term. It involves long-term contracts called PPAs to buy power from existing nuclear plants, like Vistra sites in Ohio and Pennsylvania.
And the second part is longer term.
That's the one that extends into the 2030s. That involves collaborations, investment links with SMR developers.
SMR, we hear that term all the time now. Small modular reactors, what are they exactly?
Basically, they're smaller, often factory-built nuclear reactors. The idea is to drastically cut down the construction time and cost compared to the huge traditional plants we're used to.
So companies like Oklo and TerraPower are developing these.
And Meta is essentially reserving future energy slots with them, locking in that capacity way down the line.
It really is about future-proofing. It's still amazing to me that a social media company is acting like a major utilities developer. Is this real? Or is it just ESG optics?
The analysis says this goes way beyond optics. This is a brutal competition to lock in power availability.
Right.
The bottleneck for AI is shifting. It's not just about the chips, the GPUs anymore. It's about the infrastructure, the power, the grid, the permits. One analyst put it perfectly. Venture capital is now chasing wires, not just wafers.
That's a great line. Because if you can't get the power, your multi-billion-dollar data center is just a very expensive box.
Precisely. And Meta's in a unique spot. They're not mainly selling cloud space like an Amazon or Microsoft. They're securing this for their own massive projects, like their Prometheus's supercluster.
And for them, stable power means cost control.
Critical for cost control. You cannot scale up your AI models if your power costs are volatile, or worse, just unavailable.
Okay, but here's the bottleneck I see in the data, the timing. These SMRs, the new nuclear, they're not scheduled to come online until 2030, maybe later.
Yeah.
They can't fill the immediate gap.
That time gap is where the uncomfortable reality of this transition really hits. The realistic short-term bridge, and the data on grid strain confirms this, is natural gas.
So AI demand is straining the grid right now.
It already is, especially in dense areas served by operators like PJM, which manages the grid across the eastern U.S.
And when that grid is strained, what's the go-to solution?
You fire up the high-carbon sources. Specifically, gas peaker plants, which are designed to meet those brief spikes in demand. It's the uncomfortable truth. The immediate need for 247 AI power often means using more fossil fuels in the short run.
So what's the big takeaway from Meta's nuclear strategy?
It signaled a massive reevaluation of the entire AI power value chain. Investment focus is shifting to the players who solve these bottlenecks.
So power generators, grid operators.
All of them. Power generators, nuclear gas, utilities grid operators like PJM, and the specialized data center developers. The next phase of the AI arms race will be decided by who controls the enemy.
From physical energy to political energy, or maybe strategic exhaustion in Europe. This brings us to topic 3. Geopolitical cracks. Recent analyses suggest Germany and Europe as a whole are feeling what's being called a double historical rupture, a sense that the entire international order is dissolving.
It is a profound shock. The first shock is obvious. Russia's assault on Ukraine, that's a clear external threat.
But the second shock is maybe more corrosive for Europe.
It is. It's the perceived possibility of the U.S. abandoning its role as the, manager of the rules-based order.
The German President Steinmeier used some very strong language, warning the world risks it becoming a den of robbers.
It's striking language,
Right.
and it's triggered by what they see as an erosion of international law. The data points to statements from President Trump about, minimums and compliance with global norms. That sort of rhetoric really challenges the bedrock principles Europe has relied on since World War II.
And Europe's entire foreign policy model is built on international law and legitimacy, not raw military force.
That's the core of it. So if the U.S., their security guarantor, moves away from those norms and embraces a more realpolitik approach.
The politics based on power, not principles.
Exactly. Then Europe's argument of being right suddenly loses all its negotiating power and leaves them strategically very weak.
You can see it in their diplomatic maneuvering, like with the Venezuela crisis. The EU statement was, I think the analysis called it principled but reserved.
Reserved is the key word. They'll mention the UN Charter, but they carefully avoid any direct confrontation with the U.S. position.
They're walking a tightrope.
An incredibly thin one. They can state their principles, sure, but their dependence on U.S. security, the NATO umbrella intelligence sharing it, prevents them from actually enforcing those principles. They're essentially handcuffed.
So Europe is in this lose-lose situation. If they speak up, they risk alienating their protector. If they stay silent, they undermine their own legal foundation.
That is the core dilemma, and it's profound. Strong criticism of U.S. actions could jeopardize the very deterrence they need against Russia. But silence undermines the legal argument they use to criticize Russia in the first place. This tension can't last.
So what's the response? What are European policy analysts saying is the way out?
It's all pointing in one direction. A massive, costly push for what they call strategic autonomy.
Basically building self-reliance.
Aggressively. Across defense, energy, supply chains. The consensus in Europe is that relying on the U.S. to always uphold the rules-based order is no longer a safe bet. They have to invest in their own capabilities.
Are we seeing that in actual budgets, or is it still just talk?
Oh, it's moving into budgets. It means higher defense spending, getting to that 2% of GDP NATO target. It also means targeted subsidies for strategic industries, raw materials, battery manufacturing, cybersecurity. They're willing to pay a premium to reduce their dependency.
And what are the investment implications of all this?
The Europe risk premium is shifting. It's not just about Russia anymore. It's about the what you might call the transaction cost of the alliance. Meaning if power politics replace norms, Europe will just face structurally higher costs for everything: defense, energy, trade. And the retreat of international law means more non-price shocks: sanctions, tariffs, asset freezes. That increases the compliance burden for their industries.
So we should be looking for structural support in the industries Europe is trying to build up.
Absolutely. Long-term government support in defense, cyber, and securing critical raw materials. Investment will follow that political will.
Okay, let's pull all three of these threads together. A mine in Chile, a data center in Ohio, a parliament in Berlin. What's the connection?
The connection is the soaring price of stability, whether that's resource stability, power stability, or geopolitical stability.
Right. We started with copper, where M&A is about paying a huge premium to manage resource scarcity, all while dealing with the baggage of coal.
Then we move to AI, where Meta is paying a massive power premium to lock in capacity, relying on long-term nuclear but facing a short-term gas reality.
And finally, Europe is being forced to pay its own premium, the price of strategic autonomy, to reduce its reliance on a global order that feels increasingly unstable.
All three stories are about the immense cost and complexity of structural transition. The winners in the next decade will be the ones who can manage those bottlenecks, whether it's copper supply, baseload power, or strategic alliances.
So what's the final provocative thought we should leave the listener with today?
I think you have to consider how this desperate long-term need for critical resources, the copper for our energy and AI transition, the power for that AI, how it's all going to shape political decisions. If international law keeps eroding, fulfilling that grim warning of a den of robbers, will securing these resources lead to more expensive deals, like the Rio Glencore talks, which is really just buying time? Or will the pursuit of these finite resources drive more direct geopolitical conflict?
That's the tension. Transactional solutions versus outright power struggles.
That tension, I think, defines the next decade.
A truly challenging thought to end on. Thank you for joining us for this deep dive. Don't forget to subscribe and hit that like button.